Welcome, Clyde. This is a special edition of BDE that I've been wanting to do for quite some time. It's a bit more in my wheelhouse. I still get asked questions about refracts and relative permeability, but spent the better part of the last 25 years dealing with the circus that has been public E&P equities, and I've got a guest today who has been at the forefront of all things E&P investing on the public side, Mark Viviano with Kimmeridge. But I want to interject here first the obligatory safe harbor. This is not investment advice, and nothing should be construed as such in what we discuss. And there is no reliance on anything that we discuss from an investment perspective. But Mark heads up public equities at Kimmeridge. Welcome, Mark. Maybe maybe start us off with a little bit of personal history, background, and your ramp into the wonderful world of energy public investing.
Yeah, sure. And thanks for having me, Mark. Always enjoy our conversation. So I'm glad we get to do this one on the record, let other people hear it. Yeah, it was not a direct route to E&P investing by any means. I graduated college 1999. I went to a small liberal arts school in upstate New York called Hamilton College. I graduated with an economics degree, which qualified me for pretty much nothing coming into school. I ended up, my parents, I grew up a little north of New York City, and I knew if I got a job in New York, which where most people went after Hamilton, I'd end up living at home, and just was at 21, wanted to go out and do something different. And a lot of the guys that I played basketball with at Hamilton were either from Massachusetts or were going to be heading out to Boston after graduation. So I just decided to spend a little time out in Boston, and here I am, 26 years later in the same city. Not intentional by any means. Interviewed for two jobs out of college. The first one was at Putnam Investments, and it was essentially a call center job. So when your grandmother called to find out what her balance was in her savings account or investment account, you'd pick up the phone. And I remember during the interview process, they showed us the little red button that you pushed when you went to the bathroom so it could time you how long you were away from your desk. And pretty quickly realized that probably wasn't the route I wanted to go. But my roommate's brother worked at State Street Bank, which was one of the biggest employers in Boston, and they were hiring for entry-level positions, which was essentially custodian banking for the investment management industry. And that sounds a little more interesting to me and a little closer to what I ultimately wanted to do. So I took that job, and it took me about 2 weeks to realize I was fascinated by the investment management industry, but I didn't want to be in the back office reconciling people's accounts. And so tried to do everything I could to bolster a resume that was, a little incomplete at that point. Went back to school and night took classes at BU, ultimately got a Master's of Science degree from BU, and then I did the CFA program simultaneously. So there was a few years of my life that were pretty miserable, but it was really about learning the functional aspects of the investment industry that you don't really learn with a liberal arts education. And about 2 years into that job at State Street, I got a call from a headhunter that was looking to place somebody in a position at Wellington Management in a role they called client administration, and kind of a glorified name for was essentially the back office of Wellington. So probably more of a lateral move that I wanted to make at that point. But it was moving to a smaller firm that just did investment management, got me out of a very big bank where I was always just going to be a number. And so I took that job. I still remember the first week at that job telling everybody in my group I was going to ultimately move over to the investment side at Wellington, and they all laughed at me and they said nobody ever does that. So the deck was stacked against me, but at that time the firm was still growing significantly. To put it in perspective, when I joined, I think Wellington was about 500 billion in assets. Today it's over $1 trillion. So over the course of my career, it doubled again. And back then they had a very unorganized, if you want to put it that way, investment research associate program where a portfolio manager analyst would put their hand up and say, I'd like some help. And then they'd go out and do a search for an investment research associate, which was the entry level job. And now it's a much more formal program. But back then it was a little haphazard. And so after about 2 years on the operations side, which was kind of the minimum requirement before you could interview for internal positions, a number of research associate positions opened up. And to say I wanted to be in energy would clearly be disingenuous, because I interviewed for every position that was available, including the macroeconomic team, the fixed income team, the retail team, so essentially covering Walmart, Target, et cetera. And got pretty far in all those processes, including the final two for the retail job, and didn't get that. Was pretty bummed, as you could imagine, after going through these 4 to 6 month interview processes and getting turned down each time. And about 2 months later, the energy job opened up, and I think they said 160 people applied for that job, and I'm not going to pretend I was the most qualified of the 160 people. But the two people that I would be working for, one of which, the head energy analyst at the time that covered the integrateds and the refiners, was a gentleman by the name of Neil Ashandavia. And I worked on his accounts on the client administration side. So at least he knew my name and would call me once in a while when he wanted to know how much cash he had in the account. And then the junior guy on the team was a gentleman named Greg LeBlanc, who I actually got to know because there was a kind of after work informal Wellington basketball program. We used to play basketball a lot in the North End. And so what you soon realize is being able to distinguish yourself amongst 160 applicants is really helpful when you have personal connections. And I just, at that point in my career, needed somebody to open the door crack and give me a break. And I was very lucky and fortunate. And then you think about the timing. I joined the energy team in 2004. And to be honest, that was like hitting the lottery, because from 2004 to 2008, we were the highest revenue producing team in the entire firm. And so I was just the junior guy riding coattails, but it was a great experience. But yeah, that's how I got to be where I am today. And none of it was intentional or mapped out.
Yeah, I mean, that was heading into the world famous super spike of 0405, and there was pretty meaningful pivot going on. I recall I was on the sell side. I think I was, Wellington was a regular stop on my marketing swings through Boston, and, a really deep and solid team. But there was a lot of it was very high rate of change, because you had, the Barnett, as I look at it, was really the grandfather of it all. And then quickly Fayetteville follows. You've got Marcellus, Haynesville, et cetera. So you picked the perfect moment, or maybe it picked you. And
yeah, that seems a little more apropos.
It's never let go. Making that transition and, trafficking in E&Ps, what was really the framework, the mindset as it relates to, to valuation, and what mattered and what didn't in terms of how you guys were picking stocks?
Yeah, I mean, it's a great question, because, I was able to live through what that transition was from conventional to unconventional, and, I had a pretty interesting vantage point. The first role they gave me was, you think about from 2004 to 2006, oil went from 40 to, let's say, 80. And when you double the oil price, all of a sudden there's business models that become economic that were, largely dismissed. And for our coverage universe, it was anything outside of North America. And so the first role they gave me is they said, okay, why don't you go pick up, at the beginning, informal coverage of international E&P. And international E&P at that time, as you remember, was the Wild West, right? It was mostly AIM-listed companies in London or on the TSX or in Australia, assets all over the place. The first stock I ever recommended, it's a company called Dragon Oil. It had assets in Turkmenistan. And you think about being in your early 20s trying to judge geopolitical risk in a place like Turkmenistan that I couldn't find on the map 6 months earlier. Tells you kind of what it was like being thrown into the wolves. But, that was a challenging environment, because what you realized is it was all probabilistic, right? Most of these companies were early stage, maybe had an appraisal well, but a lot of it was exploration driven. And it was really just about how many shots on goal you had, how do you risk the acreage, and then what's reflected in the stock price. And what you realize pretty early on is these should be pretty small positions and somehow diversified into a basket. And the reason I say all that is because when the unconventional came around, kind of later that decade, you could realize why long-term energy investors were so excited, because you had this repeatability and geological de-risking that we just never had before. And so I think there's kind of two reasons why shale valuations were, what some people think were excessive early on. I think one, it was, the repeatability that you would put on something that looks more durable than drilling one well every year. And then just the idea that, you're just de-risking the entire investment early on. Once you get to, let's say, 100 wells in a play, you could pretty much predict what the outcomes were going to be on specific type curves. And so it really fundamentally changed the way all of us invested in energy. What we didn't realize is, you were going to kill the golden goose because it was so good that the commodity prices would be under significant pressure and the marginal cost curve was coming down. And so, there's always this debate: what would you rather have, resource repeatability and a low commodity price, or the inability to add supply and a high commodity price? And unfortunately, the answer is these companies are more levered to price and volume. So it's probably the main reasons that the energy sector has been such a poor sector for maybe 2 decades now.
Yeah, and it's it's created a lot of derivative benefit for other industries, both in the U.S. and globally. But there was an obsession, when we shifted from the gas phase, post Haynesville and Marcellus, and basically killing gas from the supply side, because the industry was so good at executing, at least in bringing on reserves and volumes, and outgrowing, what the supply demand balance required, and then shifting into oil. But there was a tremendous amount. I think the number was, between 2010 and maybe it's a 2010, 2020 snapshot, pre-COVID for sure, but the amount of cheap debt that was readily available to fuel kind of the drilling machine. And, companies were routinely, as outspending their own cash flow to the tune of 10, 20%, if not more. And that almost seemed like, a reason to accord a premium valuation, because you were chasing purely physical growth as a proxy for value. And when I started covering this sector back in the late 90s, we were just seeing glimmers of the transition from what I call the geologic-driven model of conventional to the engineering-driven model of unconventional. But, where's the economic value was the first question I asked, and everybody kind of looked at me like I had 3 eyes. And, you get into these convoluted discussions of, economic value is really hard to measure because GAAP is the framework and E&Ps have 2 different accounting constructs, and on and on and on. Just trust us. And so there was a fair bit of skepticism, but it was a lot easier when you didn't have to go through the variety of kind of asset profiles that you do in conventional.
Yeah, no, that's right. And I think you make a good point that, people overlook this sometimes, but, it really was the intersection of the technological breakthrough with shale at the time of very low interest rates and capital availability, because that number from 2010 to 2020 was about 300 billion of negative free cash flow that was used to raise production volumes, what I would consider kind of an artificial price signal, because companies were willing to outspend. And, a lot of it did have to do with the valuations that were put on these companies early on. We get painted as the anti-growth investors, but I always say it should be a function of the valuation. I mean, early on in shale, you think about the gas companies, 2010 to 2013, those companies were trading at 10 times EBITDA or higher. They had to grow, right? Because they had a growth multiple, and were rewarded for it, at least in their share price temporarily. What fundamentally changed, and you remember this, in 2017, 18, 19, those multiples essentially got cut in half, where you went from trading kind of future development down to maybe PDP value, and yet the companies were continuing the same business model. So the reason why we and when I was at Wellington and other large institutional investors started speaking out to these companies was they didn't change the business model, despite the fact that the macro environment and the valuation regime had changed dramatically. And that's something that I think companies struggle with is that reflexivity between financial markets and operating business models. It's really, I think, tough for them to judge. As investors, we live it every day.
I heard Aubrey say one time, it was at the IPAA symposium in New York, and he had a very pointed message about look, we did our jobs too well in gas. And this was on the cusp of, I think it was 2012. We were focused, I was on the buy side at that time. We were focused heavily in moving from, the emerging investment thesis in the Eagleford to the only real game in town of any investable size, if you remember in the Wolf Camp, was down in the southern Midland Basin, which is now the forgotten stepchild of the play. And so Aubrey made the point that, look, we're going to do it again in oil. And my somewhat conventional or traditionally oriented technical mind said, look, oil molecules are a hell of a lot harder to move through nanodarcy pore space than gas. But lo and behold, what drove all the growth between what met global demand growth between 2010 and 2020 was purely a function of what we were doing with unconventional oil here in the U.S. And so there were obviously those same types of incentives to grow into your elevated EBITDA multiple. And so those were the behaviors that we saw. But the market was increasingly telling these companies in this sector, I think we peaked in 2013 as the S&P Energy as a weighting in the S&P 500 was 13%.
Yep.
What is it today?
2.8.
2.8. We haven't gotten our heads much above 5 in the last decade, or at least since the OPEC surprise of Thanksgiving 2014. And it seems like the market has been beating the industry boards and CEOs over the head with this somewhat less than subtle message, but those behaviors are still out there. And I guess how much of it is a function of, I know you've long been messaging the need for obviously consolidation and much more of it. How much is it a function of just self-interested actors in a highly fragmented industry still today?
Yeah, I think there's a lot of reasons energy trades where it is, but the biggest challenge, I think, is just the commoditized business model in a commoditized revenue stream. Early on in shale, as you remember, different plays being delineated at different times. You had catalysts, you had kind of significant movements in net asset value relative to each other. And as we get to this maturation of shale, all the companies are converging on the same business model. And then that becomes that you can arbitrage valuation multiples between the same companies. And so there's not a lot of room for multiple expansion. And so I always say the only way you get premium multiples in equity markets is a scarcity premium. Let's take NVIDIA as the ultimate example, right? There's one company that can give you exposure to AI GPUs so they can trade at any multiple you want. E&Ps would be the opposite end of the spectrum. Two companies operating right next to each other with the same model and the same capital return strategy. It's really hard to differentiate, and so they converge. And I think the challenge is we have too many public E&P companies. We've said roughly, rule of thumb, put a finger in the air. I think half of them still need to go away. And how do you do that in an industry where there's not a lot of job coming up, right? In the old days, you could go out and start a new E&P company because there was plenty of capital availability, particularly from the private equity side of the business, and then funding for the entire industry has gotten a lot more challenging. And so I think most CEOs and increasingly board members, one of the things we hear is that board members are often the impediments because there isn't another job for those board members if they sell the company. And the CEO tends to be properly incentivized through change of control, but directors don't have that same type of financial incentive. And so you have a lot of impediments that are often social around, who's going to run the company, who's going to represent the board, where's the company going to be headquartered, despite the fact that you can often have two companies operating next to each other where everybody from the outside perspective understands that they should probably merge and capture those synergies. So it's a challenge. I think we're getting there, but we're just getting there too slow given the lack of interest in the public equity market.
So from a point of reference, when kind of in the salad days of the mid 2000s into the late 2000s, roughly how many publicly traded kind of pure play E&P companies were there?
Yeah, we peaked out around 80, kind of 80 to 85, and that's kind of everything above 1 billion. There's always kind of some noise at the bottom, but we don't really look at those as
which would add significant head count, but yeah, there's
meaningless in the grand scheme of production.
Yeah, and the aggregate capitalization of the sector as it exists today is a fraction of one of the Mag 7.
Yeah.
Right.
Yeah.
So
we still have between 35 and 40 of those companies today that would be above $1 billion. And like I said, I think that needs to get cut in half again.
Yeah, and is the I don't want to say irrelevance, but the historically low profile of the sector within the broad market, is that from a big institution standpoint, I've got my CIO and I'm the energy PM. I'm not taking any kind of outsized risks with, hey, we've got to really ramp up our participation in the sector. What is the institutional, I guess, inertia here? How would you describe that?
Yeah, I think the data tells an interesting story, right? So we cut and slice the institutional ownership data every way we can, and I think it tells you what's going on beneath the surface. One, you just take the 5 largest active managers in the space. So let's take out Vanguard, BlackRock, and State Street for a minute, as they're just replicating the indexes. But you think about the Wellingtons, Capitals, T. Rowe, Fidelity, J.P. Morgan. Combined, those are the 5 largest active investors in U.S. energy. Their ownership of energy has generally tracked the benchmark. So what it's saying is they're not really taking outsized bets one way or the other. But what the biggest change has been over the last, call it 15 years, has been the composition of that ownership. And you go back to 2007, so let's think about that as the peak before everything crashed in 2008, when energy was 13% of the S&P. Only about a third of their holdings were in the top 5 largest names in the index, and those are household names: Exxon, Chevron, Conoco, Schlumberger, EOG. When we look at the data more recently, it's generally right around, if not north of 50%. And so what that's telling you is that when they do come back to the sector, they'll buy an equal weight, but they're just buying the 5 largest names. And that suggests to me they look at it as a beta bet and not an alpha bet. And by that, I mean, they want exposure to the commodity in case, war breaks out somewhere, there's some inflationary pressure that causes oil to go up. And oil can often have an inverse relationship to a lot of things in their portfolio. So they're hedging that risk out by just saying, I don't really have high conviction on oil, but I should at least own market weight of oil. And within that, own names that will not hurt me, right? They'll generally track the beta. And I think the other component of that is you think about the resources on the buy side. Folks like myself that have been doing this for a long period of time, most of those folks have left, right? Either voluntarily or involuntarily. I guess I'm a glutton for punishment, having done this for so long, over 20 years. But most people go on and do another sector or they retire. And so if you're a portfolio manager of one of these large institutions and your energy analyst is new to the job, or maybe you even don't have an energy analyst, are you really going to go invest in that small mid-cap name with some hair on it that, if you get the geological perspective wrong, could really blow you up relative to that beta bet? And so I think that has been a fundamental shift, and why we're seeing a valuation spread grow between large and small, which is, I think you either have to be in the index or you're not. It's almost binary at this point. And these small mid-cap companies that are not in the S&P 500, I think have a really challenging future.
Yeah, I heard one former IR peer colleague that I used to market with when I was on the sell side. He said, and this was about another career choice, screenwriting. He said, it's not really a career, it's an event. And I think those that are out on the outside looking in from a market size and relevant standpoint are, back to being events. Or, when I ran money for about a decade, it was increasingly more difficult to say, because of our deeper knowledge of the asset class. We pretty much came at it from an industry framework. We understood technically at a useful level what how to profile and evaluate assets, both in terms of their physical characteristics, but also in terms of risk, because it is a quirky, unique asset class. And I think what you just said about, the buy side having the attrition of expertise and just perspective on this unique asset class, I think that has played out on the sell side as well. And so, has there been an attempt or an effort to maybe rely more on the sell side because of your own in-house? I'm not talking about you specifically, because you're sitting here with 25 plus years and the gray hair to prove it. How is that, that kind of relationship changed, and what is it today between the institutional investing community and how they value and work with research on the sell side?
Yeah, I think it's a good point. That's probably underappreciated. That your typical asset manager looks at energy at sub 3% of the market, and increasingly, until more recently, probably a burden of ESG concerns and kind of this view of terminal value risk. And so, why are we investing resources in it? When you think about hiring, more seasoned investors. And so I think it's been a combination of hiring very junior people that are inexperienced with the sector, and then relying on the sell side, where you do have a few of my gray hair counterparts that have been doing this equally long, and their ability to survive, I think, speaks to the perspectives they probably have and can share with the buy side. So I think there's not a sense of the buy side's not insecure about the lack of resources and energy, because they just don't think it's relevant today. I think what's going to change is the next cycle, and we can debate when that is, 3 years from now, 5 years from now, I don't know, but there'll be a time where energy is outperforming again. And we saw this a little bit in 21 and 22, and then there's a scramble. There's a scramble for talent, knowledge, experience. But today there's a degree of complacency out there on the buy side.
Yeah, and with your earlier point about, the vast majority of institutionally impactful or significant capital is going to be in those top 5 names. And so either in-house or from a broker, there's the cost benefit of someone potentially having an edge on Exxon is that's almost an absurd thought to have. And so there is a little more, I don't want to say autopilot, but you're staying in with very tight guardrails and liquidity, and the quality of the institution. The one thing that Arjun Murti talks about a lot is the need to have a fortress balance sheet. So all those companies have fortress balance sheets, so you're not going to get hurt. In the cycles that we've seen, where we've seen repeat Chapter 11s and the somewhat humorous term Chapter 22s, that companies continue to have multiple lives. So I want to, you guys have, maybe it's a good time to talk about the transition from Wellington to Kimmeridge, which I think has a unique profile, and maybe give the folks out there a kind of a basic primer on Kimmeridge, and then we can take it on the public side from there.
Yeah, no, I mean, obviously, for a significant part of my career, I thought I was going to retire at Wellington. I mean, that's why I stayed in Boston as long as I did. It was a great firm, but fundamentally everything changed. If you think about 2018, 2019, and the view towards energy, and how uninvestable the sector had become. And I always joke it was pretty obvious to me, because I knew a lot of the portfolio managers for a significant period of time, and they'd still come by my office. I mean, I think partly they were lost on the way to the bathroom or something, but they would come by my office, and they'd first tell me to cut my hair, and then they'd tell me they were never going to buy my stocks again. And so it was a pretty glaring decision that I had to make, which was, do I stay at a place like Wellington, which, I had been there for, at that point, 18 years and thought I was going to retire there and do something different besides energy that was just increasingly becoming irrelevant, or leave and find someone that believes like me that there was going to be money to be made in energy over time. And that was not an easy decision by any means. But I did have kind of two views. One, you don't have a lot of competitive advantages in public equity markets. And one of them was I did have, at that point, 16 years in one sector and all the experience and reputation and relationships that can come with that. And so felt like giving that up at that stage of my career was really sacrificing the only competitive advantage I had. And then two, I did have this simplistic view that there was going to be money to be made in energy because of the transition, not in spite of it. And by that, I just mean in a highly cyclical, capital intensive sector, when you have impediments to capital flows, which we were seeing through ESG, returns on a go forward basis should be higher. And that was kind of my view. But I had to figure out a way to make money in public energy, which had been, as you know, a graveyard for most investors. And when I sat back and thought about it, I thought there were really two impediments to making money in public energy. One was the underlying volatility, right? The underlying volatility of the commodities, and then kind of the amplified volatility within the equities. And the challenge we had at Wellington is, outside of one hedge fund, everything we did was kind of evergreen, long only. And what that means is essentially, let's say you have an endowment or pension that decides they want to invest in energy, and you go through that process and they approve the investment. The next day, you're 100% deployed in the fund with no real thought around, is that the right entry point? And then you're just riding the volatility up and down until they call you up one day and say, we'd like to take our money back. And invariably, that happens every time you have a 30% drawdown in the sector. And so in a sector where it was hard enough to make money, there wasn't the right degree of alignment with your underlying LPs or clients. And what I was always envious of when I was at Wellington was the private equity model, because I thought not only were they stealing all the assets from the public market, and I say steal, obviously, tongue in cheek, but they had the right or proper alignment. And it was essentially a called capital model, which is you could be opportunistic. And so you just raised a capital commitment. And when the opportunity arose, your LPs delivered the capital on call, and then you were able to deploy opportunistically in the sector. And I thought that's what the public markets needed. The challenge, obviously, was nobody had really done that model in the public markets before. So that was one thing I was focused on. The second thing was the lack of responsiveness from what I would consider or call value destructive management teams. And if you think about it, Wellington, almost any company we were invested in, we were a top 10 shareholder, just given our size. And that meant we had a seat at the table with the boards and the management teams. And so there was plenty of, what they would call engagement. But that engagement essentially was me sitting in a room across from a CEO or director, advising them on what I thought they could do to maximize shareholder value. And they're really good at kind of nodding and complimenting you and telling you how smart you are. And then you leave that meeting and nothing ever changes. But what I did see is when an activist got involved, and kind of later in my career, the only one really left doing it was Elliott. We had two big investments when I was at Wellington alongside Elliott. One was MPC, Marathon Petroleum Company. The other one was Hess. And it's funny that when Elliott got involved, all of a sudden on a weekly basis, I was getting calls from either the management team or the board asking us as large shareholders what we wanted. And so the responsiveness to that engagement changed dramatically. And so if I thought about, well, how do you make money in energy? One, you need a better structure that has alignment. And then two, you need to have activism in the toolkit to be able to catalyze change and really get that degree of receptivity. So if that's your starting point, then the next question is why Kimmeridge? I knew Ben Dell and Neil McMahon, as you know, those are two of the three founding partners of Kimmeridge going back to 2004. So I talked about 2004 was when I got the job as a research associate on the energy team. And Ben and Neil were actually the number one ranked II analysts in the integrated oils and E&P at the time. They had joined Sanford Bernstein from BP. They had come from the industry, had more kind of a technical, operational, and M&A background, which for somebody like me who was new to the sector was great because they were able to teach me a lot. And the first research trip I ever went to London in 2006 was actually with Neil. So I'd known those guys for a long period of time. They went off and founded Kimmeridge in 2011. And the thesis there was essentially, we're writing research about all these emerging shale plays. Why don't we actually just go out and invest as principals instead? So they incubated Kimmeridge originally within Sanford Bernstein. And then for Fund 2, they went out and started as an independent firm. I lost touch with them completely for let's call it 7 years, didn't even really know what they were up to. And then Ben came knocking around late 2018, early 2019, because they actually recognized the valuation opportunity was on the public side. They were directly investing in resources, particularly in the Permian, and the entry price versus the public market, that gap had widened considerably. So they said, well, let's just buy public equities to get the same exposure, but recognize that they would be giving up the golden goose in private equity, which is control. So they said, what's a way to get control of the public markets? It's use of activism. So they started running a series of activist campaigns, PDC being the most notable in 2019. And we were a top 10 shareholder of PDC in Wellington. So you think about how we got reacquainted was Ben came around for our support in PDC. And we ended up voting for Kimmeridge. A lot of what Ben and Kimmeridge were saying about the need for change at the company and the industry resonated with us. But they ended up losing that vote by a small margin. And the reason why is because they couldn't get the passive vote. And for PDC, it was roughly 40% of the shareholder base was passive. And at the time, and still today, Wellington sub-advised the Vanguard Energy Fund. And so I had an interesting perspective on that vote, because Vanguard would call its managers, and the view was we were their energy manager. And so they wanted to get our perspective on any activist campaign. And so I was the E&P analyst and covering PDC. So they called and I went through all the reasons we were going to support Kimmeridge. And they said, okay, we understand why you're going to support Kimmeridge. We're not going to support Kimmeridge because we don't know who Kimmeridge is. They're a private equity firm and they have no track record of being aligned with long-term public shareholders. And so they lost the vote. Ended up getting a significant amount of the changes they wanted at PDC anyway. If you remember, they merged with SCR not too long after. But I was having drinks with Ben in late 2019, and we were kind of recapping the activist campaign and just catching up on the sector. And what came out of that conversation was I needed a platform to do what I wanted to do, which was help reform the industry and get a better degree of receptivity from management teams. And he had the platform to do that, but what he didn't have is somebody with the relationships and reputation in the public market. And we kind of left that conversation thinking there's probably something to do here. 2 weeks later, kind of around Christmas time, at least over text, we had a agreement in principle. And mid-January, I gave my notice to Wellington and joined 2 weeks later, the beginning of February 2020. And when you think about that timing of kind of what I was walking into with the whole world changing with COVID a couple of weeks later, sometimes ignorance is bliss. But that's essentially the backstory of how I joined Kimmeridge.
Yeah, it sounds very familiar. We did it on a much smaller scale, a fund I was managing back starting in 2007. And the fund was structured, it was long short, it was heavily E&P concentrated, and our public thesis was we're going to combine the best asset exposure across the plays with the best public vehicles. And a lot of these, like the Eagle Ford and then the Permian at the time, were still very embryonic. And so you're taking some relative measure of geologic risk, if you can think about just it's certainly not the type of geologic risk that you're taking in conventional, but unconventional had a lot of nuance, particularly plays like the Eagle Ford, both from a reservoir physics and a geologic standpoint. So taking big concentrations in single, relatively illiquid stocks was a bit dicey, but we tried to do our best to underwrite at a technical and industry level of depth that we didn't lever our funds, but we had the flexibility in the direction long short that we could be. But we also set up a provision where up to 50% of our committed capital could be invested in privates, whether those were pipes or pure private equity. And because of our smaller size, we were mostly doing opportunistic conventional stuff. But I always believe from a research and due diligence standpoint, there's no difference in the assets across public and private. There obviously, as you pointed out, over time can be pretty outsized differences in valuation, but giving an investor the opportunity to participate in things on the private side, it was an accounting nightmare, as you can imagine. But I think the thesis was sound from a pure, certainly research perspective, and it held a lot of logic for me. And just I think it gave us more bandwidth on our intelligence and research as well. But back to the kind of the emergence of activism. I remember for most of my sell side and buy side career, both hostels and kind of activist campaigns were always somewhat dismissed for, in my mind, not terribly sound reasons. But now I think you've seen, at least I've perceived it to be, you've seen a much more blunt and candid communication between the investment community and the E&P sector, both in terms of how, when you listen to Q&A on conference calls, or the kind of the mainstream analyst and PM community has been much more pointed. And it's taken us a lot longer to get there, just because of some of the the value destroying behaviors that went on for well more than a decade. And so it seems like the activist role has found its ideal spot from a timeline perspective. And so how would you characterize the perception of the activist is pretty kind of bare knuckled, sharp elbowed to I've kept up with the announcements that Kimmeridge has made, but I think what runs through what's out in the public domain is that there's a concerted effort to first affect change within the existing company and the existing governance structure. And then that progresses to, pushing harder for, changes that you clearly see from a maximizing value creation standpoint. It sounds like there's quite a bit of runway in your mind. Otherwise, this is not a very kind of long next career path, but it sounds like there's still plenty to do.
Yeah. I mean, I think there's two necessary ingredients for us to be successful. One is a frustrated shareholder base, and anybody that's been involved in energy for the last 2, 5, 10 years is probably extremely frustrated. And then two, management teams that either make value destructive decisions or aren't properly incentivized or motivated to maximize shareholder value. And unfortunately, that's been the DNA for the sector for too long. I like to say this is a sector that really is good at resource capture. If you give them a resource, they'll delineate it, they'll get the land, they'll capture it. Value capture is something very different, right? Because that often creates or necessitates being more dynamic about when you buy, when you sell, looking at valuations between public and private, arbitraging those. This industry is much more challenged because most of their incentive structure is just get bigger. Right, just get bigger, grow your production, merge. Who, regardless of the counterparty, just get bigger, and that means you get paid more. That means you run a bigger company, you have more private jets. Just the incentive structure for bigger versus more valuable has been a fundamental challenge to the industry. And so, when you're an activist and you have frustrated shareholder, and you have companies that aren't focused on value creation, there's a runway of opportunity. And then the question is, how successful can you be? And, one of the things that we fought early on when I joined was the track record of activism in energy hadn't been great. But I think the challenge was a lot of those were generalist investors that were activists first, energy investors second. And we obviously took a different track, which is let's take somebody like myself who's an energy investor first and had never done activism and see if that playbook works a little bit better. And there's not much competition left. I mean, if you look at who's active in the space today, it's us and Elliott. And I don't think it's a surprise that both of us have technical resources, invest directly on the private side as well, because you had a lot of generalists that came in and didn't understand how to navigate the commodity cycles and didn't understand really the kind of differentiation on the resource base. And unfortunately, sometimes activists are like a carpenter with a hammer finding a nail. They seek out underperforming companies with poor management teams, and that's fine as a starting point. But ultimately, it won't end well if you don't have the assets right. And we start at the opposite end of the spectrum, which is we'll start with asset base, and then ultimately try to figure out where those asset bases is undervalued and mismanaged. But if you don't get the asset right, as you know, in the sector, you're kind of dead in the water to begin with.
Yeah, I've often said that, we go through these extreme air pockets like we saw in the mid 2010s, and certainly what beset the industry in COVID and followed on for several years. We're still kind of reeling from things like G&A shrinkage, cost reduction, all of that. But when you bring the consultants in to do you do the reorg restructuring from an overhead standpoint, I often ask, well, the new organizational model is, at least on the surface, streamlined. You've got different functional structures or whatever the next latest and greatest is. I would ask people, well, is it the right portfolio for this organization? Is it the right asset portfolio? Has anybody taken a look at the fit of the organizational structure, function, and capability relative to the asset base? And there hasn't been, in my view, from a leadership standpoint, just a general observation. I mean, you much more than I, but we've both been active managers, portfolio managers in this space, albeit public equities, and physical assets are just inherently illiquid. It's there are different kind of friction points, but it's really the same philosophy, in my opinion, is that in this space there's a disconnect between how executive management teams, or has been, it's changing, look at the asset portfolio, and a lot of it is driven by, well, we got to get bigger. And so the notion of something that I've acquired or I've discovered and am now developing may not be a win. Is there a real signal that I ought to be thinking about changing the portfolio in an active fashion? And there's just, again, my general observation is there hasn't been enough proactive portfolio shifting and kind of reallocation that I think should be front and center as really the driving mindset of management teams in this sector.
Yeah, no, the way I categorize it is kind of top down versus bottom up. And a lot of management teams get caught up in managing their portfolio top down, which is, all right, do I want to be gas or oil, or do I want to be in 4 basins or single basin? And to me, it has to be more nuanced than that. Is what assets do you actually own, right? And the way I always have thought about investing is it's bottom up. What are the organic opportunities that you have? Where can you deploy capital, and where do they sit on the cost curve? And that's something, when we talk to companies about managing their portfolio more actively, that's usually the sticking point, is we're looking at it bottom up and just saying, well, these assets are front end of the cost curve, and these are tier 2, tier 3 assets. And if the market's there for you to sell those today, you should be selling them, because that's the value creation opportunity. Whereas they just look at it holistically about, where do we want to be positioned as a company? And it's a challenge because, as you know, most of the people running these companies in the industry today are engineers or come from some technical background. And I don't think you have enough financial influence in some of these boardrooms. And so we try to be, a voice to the CEO or to the board, and let them understand the perspective of your shareholders, who ultimately own the company, and how they think about value maximization.
Yeah, and you come you're fluent in their language as well, or highly skilled from a conversational perspective. You may have never run a reservoir simulator or drilled a well, but on location. But at the same time, there really is a credibility bridge there, and some recommendations and advice that are critical that maybe there's not as much perspective or judgment. Hey, you're a publicly traded entity, you have shareholders, the end game here is to maximize value, and a lot of these things that the industry had gotten to the rhythm of doing was almost 180 from real value creation. I used to conjecture about things. Well, if globally demand for the product is growing, I don't know, 2% a year, why does everybody need to grow 30%? That sounds like a real capital bonfire waiting to happen.
Yeah. No, I mean, you bring up a good point. And, kind of when I talked about why Kimmeridge, and one was, the ability to use activism in the toolkit. The other is the structure, and think about things more from a private equity structure when we invest in public equities. And the third would really be the in-house technical resources, because I do think credibility matters when you're trying to convince companies that they should be going down a different path. And we have a technical team out in Denver, around 30 or so individuals, geologists, engineers, landmen, and a lot of what we do from a research perspective, but also from an engagement perspective, has the full support of that technical team. And we've had instances where we'll have a call with our technical folks with a public company's technical team, and that provides a different level of credibility than if I was just at Wellington as an economics major looking at my Excel spreadsheet. You could understand why that'd be a little more challenging to try to convince a company that you understand what's right from an operational perspective.
Yeah, I covered this on the sell side. I covered the stocks in Houston and I covered them in New York, and I knew where I was more effective, or could have those meetings that would get down into layers of the organization, talk about operations, talk about reservoir, talk about geology. And those were always, I'll tell one little anecdote here. I think we were the first to start to use the basin level data to develop the typical well. And I remember it was when Anadarko was running something like 68 rigs in the Freestone, just machine gun drilling verticals in tight gas. And Bob Allison had done an interview for Platts, and we were running headlong into the collapse that happened in 2002, or 2001 in gas prices and industrial demand, because we had brought on, such a tremendous amount of supply coupled with demand destruction, and all those things coincided. I mean, gas closed December 31st of 2000 I think it was 10.00. And there were half a dozen notables at that time in the E&P sector that put on these really attractive collars when they announced in the start of 2001. But we had been analyzing based on the data that was available at the time. You could do a tight East Texas gas well, you could do a Gulf Coast well, you could do a handful of other basins. And Bob had said in that Platts article, said, even if gas goes back to $2, we're going to, it doesn't affect our activity. So we challenged that with our rudimentary analysis, and we were running out, a lot of different models and variations and sensitivities on F&D and LOE and things like that. And it made absolutely no sense to continue at that level. So what we were ultimately trying to do, because I worked for a shop that was dominated by OFS research and OFS banking, was let's not miss this next air pocket like happened in 97, 98. And so we were just trying to put a number on what kind of rig reductions we were going to see, and walking it all the way back to how should or how would a rational E&P player behave given, a radical dislocation in prices. And so during that time, we got a lot of audience with, heads of operations, engineers, production, drilling, et cetera, which was, quite illuminating at the very beginning of all this. So just a little detour sidebar there.
Yeah. Well, if we're going to do sidebars, I have a good Anadarko story for you. So I talked about in 2006, they gave me coverage of international E&P, and I guess I didn't screw it up enough that in 2007 they promoted me to an analyst, and so that was my formal coverage. I did international E&P and refining, and then 2009 they decided to give me all of North America E&P as well. And so my biggest recommendation, kind of mid 2010, in the kind of depths of Deepwater Horizon, was that we should go all in on Anadarko. And this is when the oil was still spewing out. And so I still remember June 2010, we're increasingly becoming the largest shareholder of Anadarko, and they couldn't cap the well. My birthday was in June, and I was trying to get some time off that weekend, and I was sitting at the beach. But back then they had a live feed, if you remember, when they were trying to stuff the golf balls down the hole to block it, and it was unsuccessful. And so I come back that next week, and the stock's down 20%, and the view was, if you remember, the oil was going to spread to Europe, and so we were going to take down BP, and then Halliburton and Anadarko were all
that was Matt's view, as I recall.
Yeah. So it's dark days. Anyway, we had a senior portfolio manager at Wellington who had a house, summer house in Nantucket, and Jim Hackett had a house in Nantucket. And so he comes to me kind of in the depth of this, where I'm assuming I've screwed everything up, and I'm going to lose my whole career over betting on a ability to cap a well. And he said, I was at church in Nantucket, and I saw Jim, and he was praying really hard. I don't think that's a good sign. and you just sit there and you say, of all the kind of analytical inputs, the degree of prayer was never on my checklist. So I didn't feel really good. Somehow it all worked out, and we made a lot of money on the stock because that was pretty close to the bottom. But if you think about harrowing times in a career, kind of mid-June 2010 was probably the hardest time of my career.
So let's look ahead, and I think we're getting close to wrap up. But one of the things we talked about last week offline was, I think, technology related, and we'll take it from the standpoint of, we talked a little bit. I'm keenly interested in this whole, at least perceived, arbitrage of taking undervalued gas like Waha and matching that with compute AI data center demand, and why there hasn't been more actual kind of groundbreaking movement on that. Help me through how you think about that.
Yeah, I mean, I think it's a unique opportunity for this industry to play a role in such a transformational technology like AI. We, as an industry, have what Silicon Valley needs: cheap, abundant fossil fuels, on demand, 24/7. The question is infrastructure build out, and then revenue splits. And as we've just learned with this industry, it can move slow. You often need first movers. And I really point to the risk aversion of boards. Technology relies on emerging technology relies on moving fast, taking risks, being willing to make mistakes and kind of move on. And this is an industry that can do that well in the field, but in the boardroom, it really struggles with that degree of change. And so my sense is what you'll see a couple outliers that take the lead, and then you'll have fast followers. This has always been an industry of fast followers. Unfortunately, sometimes it's a little like lemmings falling off the cliff, but oftentimes it can be a positive. And so you're going to need to see some companies move fast, create a template for what that revenue sharing and kind of capital deployment should look like. My sense is you might see it more on the private side before you see it on the public side, because they're more nimble, they're more financially incentivized to create value, and then the public companies will come behind. So I think it's just a matter of when, not if, because the natural synergies between emerging technology that needs kind of 24/7 delivery of energy, and this industry that has had the ingenuity and the resource to be able to deliver that needs to come together. I wish, and you probably wish, it was faster, but I don't fear that we're not going to get there. I think the natural competitive advantage of AI in this country is going to be energy. I think we have finally an administration that recognizes that, and so it's just a matter of time.
And when every million barrels a day added in the Permian adds another 4+ BCF a day, and that GOR continues to rise, it just seems, kind of the perfect intersection to take advantage of an arbitrage. Maybe there's some long memory about multiple compression related to the fact that maybe I decided to diversify and having my own drilling company or pressure pumping services provider, which is the type of diversification that I think has consistently been frowned upon. But this is a bit of a different strategic animal, if you will. Yeah.
No, I think revenue diversification without capital intensity is the key to the sector. So I don't think the requirement's going to be for the E&P companies to invest a significant amount of capital. It's really just going to be having a different revenue stream that maybe looks lower at times, but more consistent and durable. And I think within a framework of a large resource base, having a percentage that has a different driver is actually going to be a net beneficiary. And being able to tell that story, I think, about the integration between technology and energy is only going to help bring investors back. So I'm quite optimistic when I think about the growth of the country, the role that energy is going to play in that. I think it's all positive. I think right now we're just dealing with some concerns around near-term oil prices, and obviously weather's driving most of the volatility on the gas side. But when you look out 3 to 5 years and structurally how well positioned the U.S. E&P industry is in a maturing resource base and a rising marginal cost curve, I still think the U.S. shale industry, and particularly the companies that are going to have inventory at the front end of the cost curve, are the net winners of all of this.
Which is operating on against a backdrop of a structurally constructive or positive macro outlook. It's just more patience required.
Yeah, and energy investors aren't patient by nature. They're just been burned too many times. So there'll be some pain before the payday. But for those of us that have done this for a long period of time and have durable capital, quite excited about the opportunity over the next 3 to 5 years.
Yeah, and if people are paying attention to the energy news releases, you're going to get busy, or are busy right now with more of Kimmeridge's brand of activism. So it's exciting to watch. We could go on for much longer than this, but I want to be respectful of your time and let you kind of ramp down into the holidays and enjoy the weather in Boston.
Yeah, the kids want a white Christmas, so if they're happy, I'm happy. But yeah, every year I live in Boston now. It's been 26 years. I question why I do it, and spring comes, and somehow I stay another year. So, but thanks, Mark, for the time. Always enjoy our conversations, and have a lot of respect for what you guys are doing at Collide and Digital Wildcatter. So happy to be part of it for at least a day.
We appreciate it. Love having your voice. Like I said at the outset, this is something that's been rattling around in my brain that I wanted to do. And hopefully those that, aren't immersed in this stuff on a day-to-day basis, that may be working in the industry, are curious about how it all works and how people think about it from an investment standpoint. Because ultimately, at the end of the day, if you're working for a public company, you're getting incentivized and paid in the equity, and why it's important to focus on the ultimate objective, and that's what public companies are essentially mandated to do, is to maximize shareholder value. And the E&P sector is no different. It's just been through a really bruising decade plus, and to see someone who's been in the trenches doing this and being consistent with it, that's the end game is, I think, extremely valuable and gives our folks on Collide, our community numbers, I think, registered on the platform. This will go out in channels beyond that, but 10,000 or more, and they're these are hardcore industry practitioners who are living and breathing this industry on a day-to-day basis. So I think this is a good learning curve experience for them as well. So, well, thanks again. Hope you have a great Christmas. I'll be spending part of it in Arizona, so my weather may be a little bit better. It certainly won't be a white Christmas, but I only need
envious of that.
only need to drive up to Flagstaff to find some snow. So,
all right. Well, happy holidays, Mark, and happy New Year. Good to see you.
Same to you, man. And we'll talk soon.
Sounds good.
Thank you.